My name is Michael Grandy. I'm a professor at Providence College, currently teaching managerial accounting, and I'd like to record a short video on sales price, product cost, and gross margin. I often get a question from students on how do companies establish the sales price of their product. Well, there's basically two things that they really need to consider when a company establishes and sets the sales price for its product. First one is, what is their desired gross margin percentage that they wish to have on their product? And secondly, they want to consider what the competition is charging for their product. Both of these things are important when it comes to setting the price on the product. Well, let's first talk about what is margin, what is gross margin. And if you remember the multi-step income statement, it looks something like this. Sales revenue minus the cost of goods sold, and that's going to equal your gross margin or your gross profit. Then a company needs to subtract its selling and administrative expenses, and for the most part that will leave them with net income. And let's remember what's included in product cost. Product cost includes direct materials, direct labor, and manufacturing overhead. It does not include any selling and administrative expenses. When a company is looking at percentages, the sales revenue is always the 100% number. And we'll subtract the cost of goods sold, and then you'll have your gross margin. Let's assume, for example, that a company wishes to have a 60% margin. Well, of course, their cost of goods sold is going to be 40% because of the sales price. So the sales price is $100, for example, and their cost of goods sold, the cost of their product cost per unit is $40, then their margin will be $60 or 60%. So the question is, and we'll go through some examples, that if a company knows two things, if a company knows its product cost, that is, if a company knows its cost of goods sold per unit, and a company knows what it wants to have in terms of a desired margin percentage, gross profit percentage, gross margin percentage, then they can establish their sales price. So let's look at a couple of examples. Let's assume that the company, in example number one, that the company knows that its cost per unit, its product cost, is $80, and their desired margin is 60%. Okay, that is, they want to have a gross margin of 60%. 60% of their sales price is their margin. Well, what is that margin really used for? That margin is there to cover selling and administrative expenses and to achieve a desired net income. Okay, so a company may say we need 40%, we need 60% of our sales price to then cover selling administrative expenses and then desired profit. What is the sales price? So if a company knows that its cost per unit is $80 per unit and their desired gross profit percentage is 60%, what is the sales price? Well, let me give you a formula. And there's the formula I'd like you to remember. It says cost dollars divided by cost percentage. Okay? Cost dollars divided by cost percentage. So in our example, what is that? Well, here we're going to look at what? The cost dollars, and let's use a different pen here. Let's go to black. Cost dollars is $80, And we're going to divide that by the cost percentage, which is what? 40%, right? Because the sales price is going to be 100%. And if the margin is 60%, that means that the cost has to be 40%. So in this example here, $80 divided by 0.40, not 0.40%, but divided by 0.40 is going to equal $200. That's what we're saying the sales price needs to be. So let's look at that. Sales price, cost of goods sold, gross profit, dollars and percent, right? So the sales price we're saying is going to be $200. The cost of goods sold we know is going to be this number right here, right? $80. Sales price minus the cost of goods sold equals my gross profit. We have a gross profit of $120. In terms of percentages, what is that? Well, the sales number is always 100%. And what's my cost? My cost is what? 80 divided by 200. That's going to be 40%, right? And what is my gross profit percentage? Well, it's going to be 60%. It's also 120 divided by $200. It's 60%. So the formula we want to remember is the cost dollars, in the case $80, divided by the cost percentage, which is what? 40%, right? It's the $100 or the 100% of sales price minus the desired margin of 60% leaves you with a cost percentage of 40%. Let's look at another example. Let's assume in the second example that my cost per unit is $75 and our desired margin is 55%. What's the sales price of our product? Remember, it's the cost dollars divided by the cost percentage. In this case, it is $75 divided by the cost percentage, which is what? 45%, right? 0.45. Convert the percentage to a number. Remember that the sales percentage is 100%, your desired margin is 55%, the cost must be 45%. In this example here, our sales price is going to be $167. That's what we're going to sell it for. And let's look at it in terms of the formula. $167 is our sales price. We know our cost, right, is $75. We have a margin here of $92. What about the percentages? Well, remember, the sales number is always 100%, and the cost of goods sold is a percentage of the sales. The gross profit is a percentage of the sales. So in our example here, 75 divided by 167 is going to be equal to 45%, and 92 divided by 167 is going to be equal to 55%. Again, it is the cost dollars divided by the cost percentage. And let's look at one last one. And this example is going to be, there's this. In our third example, we have a situation where our cost per unit is $45. That's the cost per unit. And our desired margin is 40%. Again, we know those two things, cost per unit, cost of goods sold, and we know our desired margin is 40%. what's the sales price? So cost dollars divided by cost percentage equals sales price, right? Cost dollars in this case is $45. Going to divide it by our cost percentage, right? If our margin is 40%, that means our cost percentage is 60%, 0.60. $45 divided by 0.60, our sales price is $75. Percentages, remember, always 100%. Sales price, we said, is $75. Our cost per unit is $45. Our gross profit, $30 per unit. On a percentage basis, you can do the math. 45 divided by 75. Cost percentage is 60%. And we look at our gross profit percentage is $30 divided by sales price of 75. We got 40%. Desired margin is 40%. A little low, but that's what the desired margin is. So that was a quick 3 examples on how companies establish their sales price based upon desired margin. But let's remember that companies always need to consider what their competition is doing. They cannot be selling their product higher than what their competition is doing unless they can distinguish it from their competition. But you know what? I'm going to let the marketing people talk about that. So thank you very much. Enjoy your day.